Hello everybody, welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Virus Turns the Housing Market Down the Tubes. Simple as that. A lot of fun stuff going on these days. Time for a little catch-up video. Good information was released today. Again, I'm here, Randy Patrick, your host, putting the realism back in real estate. Simple as that. And today is the 21st of April, so hope everyone's having a good day and had a good weekend. Let's get into it right now. Oh, by the way, if you're not already a subscriber, if you could please click that subscribe button on the bottom right and help my channel grow, I'd really appreciate that. Thank you. So the big news of today is NAR, which is National Association of Realtors, released their March data, existing home sales data. And, surprisingly or not surprisingly, existing home sales tumble in March face 40% collapse, NAR warns. So basically, this is existing homes that were sold and actually closed transactions for the month of March. Previously, U.S. homes dropped, sales of previously owned U.S. homes dropped in March by the most since November 2015, representing weaker demand that is likely going to get much worse in the coming months as the pandemic bears down the economy. So contract closings declined 8.5% from the previous month, so the drop between February to March was 8.5%. And really the first half of the month held up reasonably well, but the second half of March, where we are seeing a measurable decline in activity, said Lawrence Yun, chief economist at NAR. Many potential home sellers are delaying listing their properties in the current economic environment, he noted. I do think it's an economic environment situation. It's also a personal safety situation. We know that a lot of people aren't comfortable listing their properties right now, having open houses, having walkthroughs and showings and things like that. It just doesn't seem to make sense at this point in time. Let's see it blow over. As well, with a lot of the pullback in the mortgage lending opportunities and the raising of FICO score requirements and standards, probably, again, your buyer pool has dropped a little bit as well too. So business closures and stay-at-home orders that began taking effect mid-month have led to listing delays and caused buyers to postpone purchases. But the median home price did rise 8% from last year. So that's one thing too. So, what they're basically saying is the fact that, okay, we did have some situations with respect to, a lack of sales, but our net pricing is going up. That's because of lack of inventory. So there's less homes available out there because homes are being delisted or not even put on the market at this point in time. And that's apparently causing a little more stress in the marketplace with respect to buying. So prices are going to rise. So basically, this is the NAR release here. So it dropped 8.5% from February, but sales did increase up 0.8% from a year-to-year basis. So sales were actually up just under 1% from the previous year, down 8.5% for the month. Basically, the median home price rose to $280,600. That's up from $259,700 from the previous year. That's a scoop. You want to take a look at the regional breakdown we got here. In March 2020, existing home sales in the Northeast fell 7.1%. In the Midwest, decreased by 3.1%. In the South, they dropped 9.1%. And the West was the big loser, dropping 13.6%. In the West. So there you go with respect to that. Some of the key points here, sales could decline 30 to 40% in the coming months, according to the chief economist at NAR, which is Lawrence Yun. So we have to realize that this is exactly what's going to happen. I guess here's the situation we're in. We're watching this unfold in real time. And that's, number one, a very unique thing, but also it means that we're just watching everything, sort of crawl across or snail's pace, etc. So we're going to see every month a decline in sales just because of what I just said. Not enough inventory out there. People aren't putting their properties out there. What normally would be the spring selling season is starting off, as a dud as opposed to what it normally does. So, again, keep that in mind here. When I look at the stats, so, I'll post the link to this in the information section of the video. But the summary of March 2020 existing home sales stats, I look at specific information here. So really, we're seeing the percent change of less than 1% year over year. We're seeing the sales change is 8% less than the previous month here. Market conditions. So first-time home buyers were 34% of the market. Sales to investors dropped big time, 13%. That's down from 18% the year before. So, in the year before in March. So you can see that what happens when there's chaos in the marketplace and uncertainty. Investors pull back immediately because they have to look down and going, okay, if I buy now and say I'm fixing and flipping or doing some cosmetic remodeling to put the home back on the marketplace, what's the time frame of that? What's the buyer pool, and what's the market going to be down the road a few months, right? 3 to 6 months. So people are going to sort of pull back. Cash sales were down 1% from 20 to 19. Distressed sales were 3%. So typically, as always mentioned, distressed sales are made up of short sales, so listed short sale properties and listed bank-owned REO properties. They were 3% of the marketplace, and that's the same as last March, 3% as well too. Normally, short sales make up about 1% of the activity, and then the remainder is based on the REO activity. Sales by region: the South had 43% of the sales, the Midwest 24%, the West 21%, and the Northeast 12%. So I do think that again, seasonality does play into some of the stuff in the Northeast for sure. Now, if we take a look at sales by price range, so 8% of the sales fell in the $0 to $100,000 category. The 100 to 250K, where 37% of the sales took place. The 250 to 500K value range, 39% of the sales were in that grouping, and then 500,000 and above was 16%. Well, that includes 500,000, 750, a million, etc., and above that. Interesting enough, the 250 to 500K sweet spot, 39% of the sales were there. So again, just we're seeing some changes. Percent change in sales by a year ago. Basically, the 0 to 100K segment market range dropped by 18%. So there were 18% less sales in that segment. And the 100 to 250K, there were almost 4% less sales in that segment as well. So everything else did see a little bit of a growth percentage with respect to their individual segments. So that's a scoop on that. All right, these markets could see the sharpest drop in home prices during the coronavirus pandemic. So really, you got to take a look at this was happening right through March. So we're almost looking at March being broken up into two segments, the first and second half here. The first 2 weeks of March, new listings were up 5% annual on average. By the second week of April, they were down 47%. So we're going from a March showing, okay, we got some new listings coming out, to a complete crash of new listings in April. So within a couple of weeks, there you go, things change. In early March, median list prices were up 4.4% annually. In the first half of April, they were up just under 1%. So I know that I've had people send me information saying, oh, look at the price decreases in my market. I can take a look on a daily basis and a weekly and monthly basis where I'm at, and I see a significant amount of, I'm seeing less listings going on. I'm seeing listings getting taken off, and I'm seeing a big number of price decreases as well too. So people who want to sell or need to sell are going to have to sharpen not sharpen their pencils, to have to lower their expectations to accommodate the buyers that are out there today. Now, with respect to markets that are going to get hit with this does remind me a little bit of the last housing crisis. It's typically warm climates and bigger locations, and where there's a lot of activity going on with respect to travel, tourism, etc. So I guess UBS put out I guess you could say a analysis of the local markets, the metro markets that be hit most by the coronavirus impact and the lack of housing movement. So they say all real estate is local, and prices will be under the most pressure in areas where the economies depend on leisure activities and hospitality. So the report mentions Las Vegas being up there, Miami and Orlando, Florida, which were some of the hardest hit markets during the subprime crisis as well too. So like anything, a lot of this stuff is historical and follows the trends. So basically, Vegas, Miami, and Orlando are going to be some of the hardest hit locations with respect to what's going to happen in the future in housing prices, and I'm going to say foreclosures as well too. Basically, in addition, UBS lists Houston as a high-risk location because of its exposure to the energy sector. Houston, obviously one of the biggest ports in the world, one of the biggest ports in the U.S., clearly employs a lot of people in the oil, gas industry, energy industry, and based on what's going on with the prices plummeting, the fighting with the OPEC nations and stuff like that, they list that in the sharp drop in gasoline usage. I mean, if we're all at home, we're not going out. And, we're like yesterday, where we lived, at Costco, I gassed up, one of the vehicles that we have, and it was at 155, and that's down from 160 something the week before. So we're seeing progressive, numbers of your gas per gallon going down. And the fact of the matter is, I'm not gassing up like I used to, because I'm not going out every day, right? So I'm doing more analysis at home. I'm doing specific property runs, or I'm trying to do things, do it all in sort of one fell swoop, as opposed to doing multiple trips during the week, etc. So that's what's going on here. Markets where affordability were already stretched, like San Francisco, Los Angeles, San Diego, and Seattle, are also at higher risk of price declines, just because they're already at the top of the market. They were already stretching and pushing the envelope with price points and values. And now, again, what we're seeing is and this is a factor of lack of mortgage. So when you've got some non-banks not even doing shadow banking, not even originating mortgages anymore, and they've held off. When you have FICO scores that have gone up, when you have FHA raising some of their standards, when you have conventional loans now saying we want minimum 720 score and 20% down. So when stuff hits the fan and it's looking, and there's no confidence in the market, what does lending do? They actually tighten up. And because, again, what the point though is that nobody wants to be the underwriter that approves that loan to the homeowner that buys the house, and then before they even make their first payment, guess what? They're defaulting because they've lost their job, or they didn't have enough income and things were changing, etc. And the lenders didn't catch that. So that's what everyone's concern is right now. And rates, rates run off the mortgage-backed security. So there's less mortgage-backed securities being purchased right now. That's causing a liquidity problem for the non-banks and some of the servicers as well too, for that same reason, right? If there's lack of confidence in the marketplace, nobody wants to package and buy loans if there's a good chance that those loans could default or go right. They don't want to buy a loan to run right into a forbearance situation. Simple as that. So this is where people are saying let's reduce rates even more to stimulate buying. Well, guess what? The lending institutes, sure, you can drop rates, but who's going to buy their loans? Simple as that, right? So New York City is another major issue. Home prices already have been tanking due to an oversupply, which has been true, and changes to the real estate tax and rental laws that had benefited home ownership and rentals prior to what's going on right now. So again, we see a lot of changes in the next few months with respect to some of these cities, and a lot of these cities were on the top 10 or 15 or 25 list of what happened in the last housing crisis. So a lot of stuff, like, we're repeating what happened for almost the same reasons. There you go. Now, I found this interesting, and what we see now is that people, we're learning a new lifestyle. We're learning a new way of dealing with people and the public, and how we manage our lives and our businesses and our workforce and the whole bit. So, you're staying home. You're not going out unless you have to. All right. So you don't want to do things to come in contact with other people. So what are the solutions to that? Well, there's been a flip in demand with respect to rural home areas that are locations away from the big cities and the suburban areas. This is according to the Redfin CEO Glenn Kelman. That he basically said that only 0.5% of Redfin's tours were virtual before the virus hit the U.S., but now they make up roughly a third. So we're seeing more virtual, but we're also seeing more rural interest, because again, here's what's going to happen. So whenever there's like a major shift in the economy or something like this is happening, like Black Swan event, we learn how to do things differently. So what are we learning today? We're learning that, hey, we can do business from our home, or we can work from home, whether it's full-time or so many days a week or whatever. Where we know that we can use technology. We're farther ahead technology-wise. We can use video conferencing and teleconference bridges and the internet, and have our online discussions and webinars and things like that. So a person now doesn't have to pay premium rent or premium property prices to live in an urban area, in a city center, or even in the suburban area, because typically, as the farther you drive away from metro location, the longer you go is proportionately how pricing works. Price drops the farther you go out. Now the quid pro quo is you're going to have to commute into the office, your place of work, see your clients, whatever you have to do. But now, since we've sort of effectively changed within the past month of how we're doing business and running our lives, definitely we're going to see a lot more demand for smaller cities and townships, a lot more rural locations, because I can get more bang for my buck out here in the country or more rural locations. I don't have to worry about being, side by side with my neighbors and having these issues that may continue on. So I do think it's interesting that we're going to probably see some shifting of where people want to live and how they want to, I guess you could say, engage people. I know that I listened to a webinar last week on Friday, and I did post that on my Facebook page. So if you guys want to hear my summary on that, please jump on my Housing Bubble 2.0 Facebook page. It's about an hour and a half of me discussing that and some Q&A as well too with the people who are on. One of the things that apartments are going, like apartment complexes, they're going to see some issues on the going forward basis. Not just because of lack of rent payment, but people are going to go, hey, I'm not going to renew my lease because I don't want to live in a densely populated location. Again, if you live in an apartment complex, you got 10 buildings or 5 buildings, whatever it is, and you got 3 or 4 floors, and you've got how many units per floor. We're all going down the same elevator. We're all touching the handrail. We're all in the parking garage. We're all going to the garbage chutes. Like all the things that we do. You can pass people, you can touch things people have touched before. So the thought process is that we're going to see some of this stuff kind of hash out, and you may see more apartment renters wanting to gravitate to the 1 to 4 units, the single family homes, duplexes, whatever, as opposed to having to live in a complex with 100 or 1,000 other people. So that's going to change the dynamics of how we live in that, and that market may look to change or suffer as well too. So kind of going along with the rural stuff too, right? We're going to learn that we don't have to be side by side, and that maybe there's quality of life, or just we'll say maintaining our life opportunities the farther out we go in the less dense that we're in, densely populated area. So I just think that's sort of interesting. All right, last article here. Fannie and Freddie not buying problem loans has the U.S. seeking the fix. So what we basically have here is, Fannie Mae and Freddie Mac, they buy the loans they're guaranteed by the government, right? So the regulator is confronting a fresh crisis for the U.S. housing market. The companies won't buy recently issued loans that were made to borrowers who are already who can't afford their monthly payments because of coronavirus. So essentially, normally Fannie and Freddie would pick up those loans, they'd buy them, they'd underwrite them, they'd guarantee them. Well, guess what? They're going, no, we're not going to. We're not going to put ourselves in the situation. Like, why would you want to guarantee what is already a bad investment, right? So we know it off the bat. So if somebody got their loan, a month ago or 2 months ago, and they can't pay it now, they're in the forbearance process, or they're trying to figure something out, Fannie and Freddie don't have to buy it, and they don't want to buy it. So, which is interesting, because if you recall back after the last mortgage crisis, there was something created called the CFPB, Consumer Finance Protection Bureau. All right, that was created, and a lot of what the CFPB did was put in a lot more stopgap measures and disclosures and processes, etc., that were designed to support the homeowner from not being, fooled or tricked or hoodwinked into loans they don't understand, better reporting, better disclosure information. So you knew that, hey, I've got an option arm loan and I know that I can qualify now. Do I qualify in the future, or do I know that it's going to change in the future? Are you prepared for that? So a lot of things, because of what happened in the last housing crisis, a lot of things were put in place to fix some of those obvious problems. And one of those CFPB things was having the lenders do what they call stress tests. Like, in other words, they went through scenarios where, okay, if there were events like hurricanes and earthquakes and fires and stuff, could a lender sustain themselves with respect to a bunch of non-payments or forbearances in the event of a kind of a tragedy, catastrophe. So, and apparently that all worked out well. So right now you've got these lenders saying, well, help us out, and essentially FHFA is basically saying, no, we're not doing this at this point in time, because we went through that with you guys before. So I do kind of find that interesting, and good in a way that they're not just jumping right away to bail out some of these players, though there could come a period of time when things are going to change. I've already read some stuff today, and I didn't want to talk about it right now, but I want to digest it first. That there's some things that the government may support to a point, and then they're on their own. So we'll see what happens. But I basically they're going to look at, they want to see how this plays out. That was the thing. They want to see, right, again, we are so early in this. That's what I mentioned about real-time, watching this unfold in real time. Like literally I'm on the internet all the time, clicking articles, reading stuff, looking at, papers that are being written by analysts and economists and investment houses. I'm looking at all the news articles that go out. I'm looking at statistics. I'm looking to see what listings are doing and what foreclosure filings are doing and things like that. So, we're seeing all this stuff sort of hit us in real time. And, it's a lot of information to take in, but it's important information because we're trying to figure out what's going to happen in the near term. So the near term, the year term, whatever. So I can tell you that we will see a lot more distressed sales. We will see more defaults and more delinquencies. That's going to happen. It's just simple as that. There's no way about it. We were already at 3 million, approximately 3 million, mortgage forbearance, we'll call it requests, applications, the people wanted in, as of, last week. So we've got one more week that's transpired. I know this week we'll find out where that took place. And this is only with April. So today is April 21st. We're 3 weeks into April. And, there still could be more people that don't pay their mortgage. There still could be more people that are having rent issues. And then guess what? Another week, we're going to be in May and we're going to see what's going to happen there. I could bring the next wave of people. So people who lost their jobs throughout the month of April. Now, when May 1st hits, all those payments are due. So we'll see what happens there. So we're really so early in this. It's tough to predict, but I can tell you that a lot of the economists that I'm reading, I've been on a lot of sort of, we'll call it private webinars and information calls that, there'll be distress. There'll be distress. This will pick up. It's going to come in phases and in waves. I can tell that 2021 is going to be a busy year for the default stuff. There's no doubt about that. But right now we're going to start seeing stuff happen within probably 30 to 45 days because the people that already had their foreclosure sale dates postponed, once this moratorium's over, they're going to go right back into the docket and they're going to get reset. So we're going to have that wave happening. And then we're going to have, all the foreclosure filings that didn't take place over the past 2 months because the court systems were either closed or slowing down or the lenders didn't bother. That's going to pick up again. So we're going to start seeing this stuff happen in waves, and it's going to sort of be it's going to grow. It's going to be the first wave, second wave, third wave, and there's more to come here for sure. Next video I'll talk about some interesting statistics and some thoughts that we've not really even discussed yet about where some of this is going to go and just how the dominoes are going to fall. But again, when you take a look at what we spoke about here with some of these the areas that are going to see the sharpest decline in home prices, well, kind of like before. When you so for me, what I remember most about the last housing crisis were they called them the sunshine states, the four big states: California, Nevada, Arizona, and Florida were your four top states for foreclosure filings, foreclosure sales, the whole bit. A lot of those locations saw the most exponential home price appreciation. They saw the big time depreciation. Different cities experienced this within those states, and of course New York City area as well too. So that's kind of what we got happening in the next little while. So it doesn't surprise me. A lot of this mirrors what happened before, and we'll just see how this plays out. The difference being we don't really have the speculation we had before. We have a much more serious financial implication of, it's not like I'm choosing not to pay my mortgage because I don't want to, the option arm reset, I don't like the values, blah, blah, blah. It's the fact that you can't because you don't have income coming in or you're trying to conserve your income, and that's what's going to happen the next little while. So be prepared for the worst. We'll hope for the best. For those of you out there, this is what I do and what I want to do and what I'm going to really work hard to pursue. So a lot of that stuff's going to happen, and I'm already gearing up, doing a lot of analysis, getting marketing ready, so getting stuff out there, going out, driving around, looking at properties and stuff. So a lot of things are starting to hash out. Will there be good deals now? Yes, there'll be good deals now. So one of the questions that people always ask, and this is the most, as I think I talked about this a few times, but this is the most difficult thing to answer, is there obviously, you don't want to overpay for a property, right? And everyone gets that. I get that. It's an obvious thing. We don't want to have to overpay for a property. You don't want to have buyer's remorse the minute you buy something, but there will be good deals. There will be opportunity because we're here now and we're seeing a decline. And it's just the fact that we can't predict how fast it's going to go and how far it's going to go. But what I want people to do is make sure, like if you're looking to buy a house, what should you do? review your loan, your financing, okay? Because has the financing changed? Is your lender still offering what they offered you before? Has your rate changed? Has your qualification standards changed? Maybe your rate's gone down, but the stipulations and requirements that you have to come up with have changed. So be prepared for those changes and be aware of that before you start placing offers. Can you ask for discounts? Can you ask for a reduction in price? By all means. There's no reason why you should do it all the time anyway, but now there's a greater opportunity because, here's what's going to happen is buyers will be the new currency. Buyers and lenders are going to be the new currency. And what I mean by that is I'm a buyer and I'm a well-financed, guaranteed buyer. So in other words, I've got a pre-approval. I've got, I know I can buy this property. My lender's giving me the green light and I'm good. That's going to be the new currency out there. So home sellers who have to sell or need to sell, they're gonna have to wheel and deal, and they're gonna need to have that pool of good qualified buyers to buy their properties, and that pool may be shrinking over the next little while. From the investment perspective too, what you're typically going to see is you're going to see a lot of investors that get spooked and want to get out of the market. So they essentially should have gotten out last year, but they didn't, and they're trying to sell. Now, where it does make sense is you can still pick up investment property that's cash flowing right now. I mean, there'll be deals, and that's the thing. You just offer what you can offer, do some negotiations, still to kind of get it. That's what we sort of work on over here, because a lot of times investment properties don't necessarily tank the way single-family homes from the user perspective does. So having a home or a property that cash flows, there is some insulation against the market when it declines in value. Now you don't want to still buy everything at the peak and overpay for things, but there's got to be a limit. And my point to everyone is, don't just turn your nose up at things because you expect there's going to be this massive decline in pricing. And oh, by the way, when people who say, I'm going to wait to the bottom before I buy, you don't know it's the bottom until the bottom's passed you by. That is the number one thing, because again, real estate is what? It's based on comparables and sales that have happened in the past, not the future. So we won't know we've hit the bottom until there's a price increase and volume increase and things go up in price. Then we've missed it. So that's why I'm trying to say this is the tricky part of real estate. Is timing is everything. We don't have a crystal ball, but we do have a lot of history, as I always say, that happened in the last housing crisis and what's going on right now. So we can use that to sort of temper what we're doing. Be clear, I'm not advocating people to overpay for properties. I find I have to say this over and over again because somebody will say to me on the comment that, hey, you're telling us to buy at the wrong time. Listen, from an investment perspective, you're getting a good deal. It's never the wrong time to get a good deal, regardless of what you're doing. All right. You just have to be aware of where the market is. Does it cash flow? Are you doing it for the cash flow? Are you doing it for the appreciation? What are you doing, etc.? So just again, analyze things, look at trends, look at numbers, ask questions, ask others for advice. Don't necessarily rely upon the realtor who needs the sale to provide that advice. Maybe look elsewhere or get a second opinion or ask their opinion directly. I mean I've told people point blank going, I think you're overpaying for a property right now. And again, if you need to buy for various personal lifestyle reasons, change of jobs, relocation, whatever, sometimes there's no way around it. As I always say, just try to get the best deal possible. And now I think the world of negotiation has opened up a lot more where you have some play and some flexibility now. All right, guys, having said that, thank you once again for the comments, likes, and the shares. If you're not already a subscriber, please subscribe and help my channel grow. If you'd like more information on my off-market property stuff, which we got lots going on right now, if you'd like more information on training for this upcoming distressed market stuff, please drop me a line, send me an email, give me your phone number as well too, so I can text and get in contact with you. We have a lot of things that are going to be going on next little while. What I'm doing right now is I'm essentially revamping all my training stuff to, and this is what I've noticed, I'll just share it with you guys right now. We have like 3 segments. We have people who want to buy a home, and that's all you want to do, and you just don't want to pay premium price for it. You want to feel you've got a good deal. I'm amending my training to include that. We have the typical investor stuff that I typically train on for short sales and foreclosures and stuff, which is, I'm improving that, but that's sort of our basis. And we also have real estate agents who are like, hey, how can I get into this game? I want to prepare it and be ahead of the curve and already be marketing to these people and supplying the buyers and stuff with these properties, as time goes on. So that I've added and am adding more in that vein as well too. So that's what I got going on here. So drop me a line if you want more information. A lot of fun in the future. So again, everyone take care, and we'll look forward to speaking with you later on this week.